Welcome to UBP TV. The red growth should continue in 2014. The US growth has led the recovery among G7 countries, but risks are coming back on the agenda. What risk could derail the US growth? The major risks are coming from the fiscal situation, with a fifth battle around the 2014 budget and uncertainties concerning the debt ceiling. First, the budget situation. As growth has recovered, fiscal situation in the US has significantly improved from past years. The budget deficit to GDP ratio is expected below 4% this year, and the 3.5% could reasonably be expected next year. The problem is that Republicans do not want to finance the Obamacare reform, and Democrats declare that there is no negotiation. This explains why there was this government shutdown in the first day of October, which is also the first month of a new budgetary year. How much this government shutdown will cost? Past estimates show the cost is around minus 0.1, minus 0.2 percentage point of quarterly GDP per week. In 1996, during Clinton mandate, the shutdown lasted 21 days and cost more than 1% in terms of GDP. And the current situation, the cost seems totally manageable, but it means this shutdown should not last more than 2 weeks. Second, the debt ceiling. Markets and politicians do certainly remember the tough negotiation around the latest rise of the federal debt in 2011. At this time, markets had strongly corrected, and popularity of politicians had also significantly eroded. The stakes are far more important on the debt ceiling because there is a risk of a technical default after the government will run out of cash in early November. This is a highly sensitive and political matter just ahead of midterm elections expected next year. How to solve the situation? The president has the legal possibility to increase by his own decision the debt ceiling, but this is not the political tradition. We could have a third-party commission or top negotiation between White House and Congress. A compromise should be found at the last minute, and we think most negative scenarios should be avoided, but the process could emerge after a longer period of time than currently estimated by the consensus. Of course, this fuels uncertainty and volatility in the market, but it should not derail the US growth trajectory. The second major risk is coming from the bond market, with the past rise seen in Treasury yields. But the Fed has decided in September, contrary to consensus, not to change its quantitative easing, and it will continue to support growth. Expectations on interest rates have come down on money markets, and long bond yields eased significantly from the 3% level reached and the 10-year Treasury in past summer. Fed remains data dependent, but how long as uncertainties are in place from the fiscal situation and how long as there is no strong growth in place, Fed will continue to maintain a very accommodative stance, taking the risk of being behind the curve. All in all, this means that we should expect, after a weak GDP growth in the third quarter, around 1.5–1.7%, some recovery in the fourth quarter after the end of fiscal uncertainty and a return to 2% trend. Thus, growth is expected next year around 2.5%. The US should continue to fuel the red growth, and also United Kingdom and Germany will also participate and contribute more, as their growth should be close or above 2%. At the end, these remain good news for Western economies and also positive news for the markets. Thank you, and see you soon on UBP TV.